Mistakes can not only cost you a lot of money, but also make you feel insecure during the home buying process. My name is Aguinaga, and I've been a real estate broker in Montreal for over 15 years. Sadly, I've seen many people make costly mistakes before working with me or my team. Today, I want to give you all the information to help you avoid these common mistakes, completely free, no strings attached. My goal is for you to confidently make one of the biggest purchases of your life with confidence. If you have any questions, please feel free to reach out. All my information is in the description down below. If you want to book a call with me to talk about your specific situation, please do not hesitate to contact me. I'm here to help you with all your real estate needs. Now, let's get started. The first item on the list is not getting professional advice or contacting the listing agent directly. Now, this is super important because you have to understand, especially since June 2022, when the law made it even clearer, the listing broker represents the seller's interest. Their job is strictly to do everything possible in order to get the best deal possible for their clients, the sellers. You want to hire a broker who's going to represent your best interest, therefore a buyer's broker or somebody you're going to hire directly. By signing a brokerage contract of purchase with a broker who you've hired, who you've chosen, who you've interviewed, and who's going to stand up for your rights, you finally have somebody fighting for you in your corner. Now, it's important to make the distinction here between going straight to the listing broker, hiring somebody, and why should I do this? What are the advantages? Well, in anything I do, I want to choose my expert who's going to defend me, whether that's a doctor, a lawyer, any type of professional, an architect, you name it, inspector. I want to make sure that I've chosen them so that there's no conflict of interest over here. When you go directly to the listing broker, you are, whether you like it or not, risking a conflict of interest. Now, obviously, we are held by an order of professional liability, and we have to be neutral to a certain extent. However, it's a very gray line. Where does neutral stand? Where does it not? There's important information that your broker might go out, might look for even deeper to get to protect you further that a seller's broker or the listing broker wouldn't have to do because they've presented all of the basic facts and it becomes your responsibility to dig anything deeper beyond that. So it is always crucial to make sure you have somebody working for you. It doesn't cost you anymore. It's already baked into the transaction one way or another, but you want to make sure that you've hired a professional to protect you. Number 2 on the list, running a big credit card balance or making big credit purchases before the closing. Now, it is super important to understand that until you go to the notary and you actually sign for the property, the bank reserves the right to withdraw the loan. Because on your approval, in the small print at the bottom, it states that if there's any significant changes to your credit situation or your employment situation, the bank is allowed to withdraw their financing approval. Therefore, I cannot implore you enough to ensure that you do not make any large credit card purchases. I've seen a client once decide to go finance the pool for his new house, buy a new car and furniture, and the bank retract the loan a week before the closing. They're allowed to do this. Therefore, you have to make sure that you've actually purchased the property, you've gotten the mortgage issued. At that point, you can go out and make these large credit purchases if you want. Now, again, always be responsible for your credit. I'm not saying to go out and spend as much as you can, but make sure you don't put in jeopardy this house that you've worked so hard to purchase because you couldn't wait an extra week or two. Because there was a promotion that you didn't want to miss out on, that promotion could mean that you don't get the house anymore. So make sure you do this. A couple of extra tips on managing good credit would be make sure that you always pay on time. Whenever the due date is, make sure you pay by that date and even pay at least 3 business days before because a lot of us are paying with online banking these days and it takes up to 3 business days for that to get processed and received by the other entity. So it's super important to know that. You want to make sure that you always have less than 50% of your credit utilization. So if you have a credit card that has a $10,000 limit, make sure that you don't surpass $5,000. And also you want to make sure that you're not closing credit cards unnecessarily. If you got your first credit card when you were 18 years old and it might only have a $1,000 limit on it, don't close it unnecessarily. You can even increase the available credit on it to maybe $5,000. Make sure that you use it maybe once a year, buy milk, go to the groceries, whatever you want, and keep it open because when the credit bureau sees that you've had credit for a long period of time, that you always make your payments on time, and that you have low credit utilization, therefore you've used a small percentage of the credit that you have been afforded, your credit rating is only going to go up and get better every single time. So these are my tips to make sure that you don't mess up your purchase in this case. Number 3, not being pre-approved. I see this time and time again. I have clients or even past clients call me, hey, LJ, I want to go see this property. And my first question is always, hey, have you taken the time to get pre-approved already? Like, oh, no, I really want to. I was like, look, great. Let's reach out to your mortgage broker today. Let's make sure we have something on paper because the last thing I would ever want for you is that we go see a property, you fall in love, you picture yourself in this house for the next 15 years, only to find out that you don't qualify for this mortgage. So these dreams, these hopes, these aspirations, you've taken your wife, your kids, everybody's super excited. They're already envisioning it. And we can't make this become a reality. So in order to avoid that, in order to avoid an uncomfortable situation for yourself, for your family, for everybody, until you're pre-approved, we can't go out and visit properties. You're also spinning your tires if you go through the process, if you pay for an inspection, pay for other specialty tests, etc. You've wasted money, you've wasted time, and you've wasted energy. And that's the last thing I want for everybody. I want to make sure that if we're going into this, we know that you've already been pre-approved, you know that you're ready to do this, we've gone over all the costs, and you know what to expect moving forward. Number 4. Only looking for mortgage rates from one lender. Now, a lot of people will ask me, LJ, should I shop around with my pre-approval? And I say, no, for the time of the pre-approval, honestly, just go to one institution, get a pre-approval because their qualifications are going to be quite similar across the board. And to be honest, if you want, go to a mortgage broker that's going to look at different institutions' ways of qualifying to see what options you may have, depending on the type of property that we're looking at. But when it's time to actually decide on a mortgage, that's the time when you can actually shop around if you'd like. That's the time to go compare different banks, compare different penalties, compare different time periods. There's a lot of different factors that come into choosing a mortgage. It's not always just the rate. There's obviously the conditions that come along with it. And even though it is extensive paperwork, so most people try and skip it, it's super important to understand the rate, the time period, the penalties for breaking it early, can you port your mortgage, what your prepayment options are, and all of these things should play a huge role in deciding which mortgage you want to go with. So compare different options. The next mistake I see, number 5 on our list, is mistaking closing costs with the down payment. These are two completely separate things. Every institution is going to ask you to have about 1.5% of the purchase price set aside for closing costs. Now, what's included in your closing costs? You're going to have your inspection, your notary fees, your welcome tax, any adjustments at the notary, potentially a CMHC tax for your mortgage insurance. This is very different than your down payment. Your down payment is a percentage of the purchase price that you've agreed to put down on the property, and closing costs are these one-time costs that you're going to have associated to this purchase. You can't just say, I have this much money, it's my down payment, and I'm good to go. You have to remember that there's the additional costs of closing costs whenever you buy a property. And I make sure to go through all of this in our buyer's consultation because I want to make sure that there's no surprises for you along the purchasing process. Number 6, not making an informed offer. What I mean by this is you go see a property, let's say the asking is $800,000. You say, okay, well, I guess I'll offer $790 because I feel like negotiating a little bit. My answer to every client when they say, hey, what do you think I should offer is, let's look at the comparables. The comparables are truly going to tell us what this property is worth. And in some cases, it might be a bit more difficult to get recent comparables because of XYZ reason, but we want to study the last 6 months, 12 months, possibly 18 months of transactions for a specific neighborhood, for a property type, so we understand what the market value of the property is, and our offer is made in consequence of that. If you don't take a look at the comparables, which your broker is able to provide you, then you're really just kind of shooting in the dark, and that's no way to make the largest investment of your life. So make sure that you're comparing what is really important about this property, what the recent comparables are, and what conditions you're putting into your offer to protect yourself, which again, all comes back to hiring a broker to represent your best interest with the entire transaction and not going directly to the listing broker. Number 7 on the list, overlooking first-time homebuyer programs. Now, there's a lot of benefits to being a first-time home buyer in Canada. I recommend you check out our video, RRSPs, TFSAs, and FHSAs to buy a house for detailed information on each program. However, in general, these are programs that will give you either tax credits, refunds, access to funds that you cannot typically touch in order to purchase a property, and make the whole process a bit more affordable and a bit easier. So make sure that you've spoken to your broker or to your financing professional to understand what programs are available to you in your specific case and how to take advantage of them. Also, please remember that if you are using any registered funds, it's going to take at least 2 weeks to get access to the funds. So make sure that you go to remove the funds from those registered accounts at least 2 weeks prior to avoid any unnecessary delays and be homeless for a couple days in between that period. Number 8, not seeing past the home's appearance. Look beyond superficial aspects like furniture, decor, and clutter. You're really here to focus on the key features of the home. We want to look at the structure, we want to look at the exterior shell, and we want to look at the potential of the property. You can't just be wooed because it's decorated nicely or because it was freshly painted. You really want to understand the bones of the property. Are those solid? Does the property have everything you need to make it your home? Because it's very different to buy a house versus a home, and that comes down to what you can do with it. But you want to make sure that the structure and the bones of the property are solid so you can go right into putting in all your things the way you want, the way you like to live in your home. Number 9, not keeping enough money for extras / an emergency fund. It is super important to have an emergency fund. You've now taken on home ownership, and that is wonderful. However, like with any major purchase or ordeal, there can be surprise expenses from time to time. Your roof might have a leak that you really weren't expecting because of a windstorm, because of an ice storm, etc. There might be a problem with a window, foundation, something that you really were not attuned to because, again, there's just the elements that we're exposed to every single year, especially in Montreal. It's currently about 45 degrees outside. We go down to -40 in the winter. That's an 80-degree or 85-degree spread from one season to the next. Things are going to happen. Obviously, all of our construction materials might wear out prematurely. They might have different defects associated to them. So you have to be ready for an emergency expense to come up. And the best thing to do is to start saving. Save a small percentage from every single paycheck into an emergency fund. I typically recommend having at least 6 months of your mortgage, taxes, utility bills saved up as a start because you might not need that, but you can utilize either that in case you do lose a job, or you can use those funds in case there's an emergency expense that you were not prepared for. So make sure that you've built an emergency fund for your family. Number 10 on the list, not checking the utility bills. It is essential to understand the utility costs of a home. It can save you money in the long run and can really prepare you for what to expect. Some properties just have electricity bills, some have electricity, gas, some even still have oil right now, and some are geothermal, so it works a little bit differently, but you have to understand what costs to expect. If you've been budgeting $100 a month because that's what you currently pay, but you're all of a sudden going to be paying $250 a month for all utilities, this is a huge swing and you might not be prepared for this. So you want to make sure that in your due diligence, you've asked for recent utility bills so you can have a good understanding of what the utility costs on this property are going to be. Make sure you get propane bills if you have a propane fireplace or a propane stove. You really want to make sure that you understand what this home is going to cost you because it goes far beyond mortgage, taxes. There are a lot of other things to consider. So these are my top 10 mistakes. In the end, most of these mistakes could be avoided if you work with a knowledgeable real estate professional. I hope this information helps you in your home buying process and gives you the confidence to make the right choice. As I said before, if you have any questions or need personalized advice, don't hesitate to reach out. All of my contact information is in the description down below. Thank you for watching. If you found this video helpful, please give it a thumbs up or leave a comment down below, share it with others who might benefit, and subscribe to my channel for more real estate tips and advice. Best of luck on your home buying journey. Until next time.